Hi everyone, I'm John ZALLER, CIO of MAI Capital, here with your latest edition of the MAI Market Update. This month, I'm happy to be joined again by Chris GRISANTI, MAI's Chief Equity Strategist, as we take a look at the outlook for the equity markets heading into what is sure to be an eventful fourth quarter of 2020. So Chris, let's start off with what's probably top of mind for most everyone, and that's the election. Obviously, a lot of concern on both sides of the aisle, and now with the recent COVID diagnosis for the president, just adds another issue that could impact the election result. So as you think about heading into November, what are you most focused on in terms of the election?
Thanks, John. It's nice to be on the call again with you and also talking to our clients. As far as the election goes, I think there's 2 points to make. The first is, as proved by 2016, they are unpredictable. You really don't know what's going to happen. And secondly, you don't even know what the market reaction to what you can't predict in the first place will be. But the more important thing is, I feel like the election is like a magician who's waving a handkerchief over here when the real action is going to go on in a different place. We see the real action as 2 things. One is COVID, the COVID news, bad cases emerging in the winter, being in tension with a vaccine that gets approved in the winter, in the spring, and then the acceptance of the vaccine. So those pieces of news are what's vital to the long-term earnings power of our investments. And that's, at the end of the day, what matters to make money. So the second thing that's important is economic news. So we will see whether we can climb out of this huge hole of unemployment that COVID has dug for us. And our opinion is maybe a little more negative than most, which is that it will take several years for us to get back to a sense of normalcy, both in our regular lives and in terms of the economic statistics that we had just at the beginning of this year. If you look at this chart, another important thing to remember about the election is that at the end of the day, Democrats, Republicans, they don't matter so much as these other factors that I've already mentioned. So for almost 100 years, the results for a split government are about the same. You get, ironically, you get a little less return from the markets if either one of the two parties controls both the presidency and the legislature. So if they're undiluted, that's a little worse news, but it doesn't matter which one they are. So we think that stay the course. You have an investment plan that's been laid out for you by your MAI manager that is supposedly to last 10 years or more. So don't let the events of the next few weeks upset that apple cart.
That's very helpful perspective, and we have been giving the different configurations of government that could be the case in the next administration. We've been giving it a lot of thought, and the Democratic sweep scenario would likely be the most disruptive to the status quo, could result in higher taxes and regulation. But even that we would view as more of a dent to earnings growth rather than a derailment of earnings growth. And so we would dissuade investors who have concerns around the election, but as Chris said, are still long-term investors. We'd dissuade them from making too big of a move based on an election result that's, as Chris said, unpredictable and also hasn't mattered much historically in terms of market performance.
If you were afraid, for example, in '92 of Bill Clinton or in '08 of Obama, they said they were going to raise taxes, and they did. You would have been right. And yet the markets under both of those presidencies, for a variety of reasons, was just fine. And so don't let this political stuff spook you when there's really so much else that is legitimately scary.
So Chris, since the start of COVID, you've been emphasizing what you've termed margin protectors, which are companies that can protect or even grow their earnings in a more difficult economic environment. These are companies in the technology, healthcare, communication services areas. And frankly, these companies have done extremely well this year. So well that many are starting to become worried that we're in a bubble in growth stocks. So I guess that's my question. Do you think that we're in bubble territory in the growthier parts of the market?
I don't, John. That's a great question. But the reason I don't think we're in a bubble is 2 reasons. One is that these companies, while they have risen in price quite a bit, are actually worth more now than they were before. So take examples from the marketplace. Amazon or Domino's Pizza, two very different companies, but both have seen their revenues increase because of an increase in digitization. In Amazon's case, obviously people are ordering from home. In Domino's case, they're ordering online and getting a pizza delivered. So these companies are actually worth more now than they were at the beginning of this year. The second factor is that these have what I call an island premium. And the reason I say that is when you're lost at sea, you'll pay up for an island. And in this slow to no growth economy, these companies are, I think, reasonably a more attractive place to put your money. So I think just like the election, you should stay the course. I would stay the course with these margin protectors and not be deterred from investing in them because they've risen in price. A final piece, and I want to put some details and some evidence on the bones here, is if in this chart we show 5 very large companies, all of which I would call margin protectors. They'd be Facebook, Amazon, Apple, Microsoft, and Google. So those 5 companies obviously make up only 1% of the S&P 500, but they make up 22% of the index by market capitalization. You might say, oh my gosh, that's a bubble. But if you look at the cash that they produce, these 5 companies, again, just 1% of the S&P, produce almost 19% of the whole index's cash flow. So they're a little overrepresented. 22% is larger than 19%, but they're not hugely overrepresented. These are not the same companies as the tech bubble in 1999, which I also lived through. These are companies with huge cash flows, and most importantly, they're able to produce those cash flows and grow them in this very difficult time.
So Chris, I'm hearing stay the course. I'm hearing continue to emphasize margin protectors in portfolios. But let's say we do have a significant correction in November and December. What would be on your shopping list, if you will, to buy for the long run?
John, it would depend on the reason for the correction. If, as in a worst case scenario, we have political unrest, we have a contested election, frankly, I'd stay away from picking and choosing in that marketplace because there's no historical precedent. But as I suspect is more likely the case, where COVID cases might increase, where economic statistics tend to trend downward, and the market swoons because of that, I again would stay the course. I would look towards these margin protectors. I'd look in technology, communications, healthcare, any of those places, and other industries besides, which can protect their profits even in a slumping economy. And again, pay up for them. Don't skimp.
That makes sense. And to add to that, one of the areas that we've been thinking about be adding to in the future would be international stocks. We've long been believers in the benefits of international diversification, but frankly, it hasn't paid off over the last decade. International stocks have trailed the U.S. by a significant margin. But if the U.S. premium to international has been based on geopolitical stability, more competitive tax and regulatory regimes, and a strong dollar, all of those linchpins may start to change following the election. So international markets might finally become the hedge we always hoped they would be.
Yeah, I tend to agree with you. And to close up, what I really think is somewhat ironic is that since World War II, the U.S. has been a hedge against political unrest overseas and instability, and now all of a sudden international markets are a hedge for our potential political unrest and instability. So you live long enough and you see just about everything.
Well, Chris, thank you so much for your insights today, and thank you to all of our clients for listening in. These next few months are sure to bring challenges, and they will test the resolve of both the markets and also of ourselves and our clients in order to maintain a long-term perspective, to, as Chris said, focus on the things that really matter to long-term profits, and by extension, to achieving our clients' goals over the long run. So as always, we appreciate the trust that you've placed in us to help you navigate these challenging times, and we would encourage you to reach out to us either through the email on your screen or directly through your wealth advisor with any questions. Thanks so much for listening, and we'll see you next time.